The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, Tuesday's trade action, not a friendly day to the markets really across the board. We saw pressure in grains and oil seeds, livestock, energy, stocks. Soybean oil was really the only market that found some green on the day, Tuesday, and I'm particularly concerned about soybeans right now. So we're going to talk about that and take a look at the market action from Tuesday's session here on today's Market Talk program. Joining us now for analysis, Jim McCormick with agmarket.net. Jim, how are you, my friend? It's good to have you back on the show with us.
Hey, Jesse, I'm doing well. Thanks for letting me or inviting me on. I appreciate it.
You bet. You bet. Well, to my point there in the open, I'm a little worried about soybeans. We did rally a bit off of the session lows on Tuesday. I have to think a pretty good NOPA crush number. Bean oil stocks showed the lowest stocks in 10 years. As I mentioned, that helped soybean oil trade in the green. I have to think that spilled over and helped somewhat for soybeans, but I'm a little concerned, Jim. It feels like we've probably done some chart damage here. Talk about this. Would you agree? Have we done some chart damage to soybeans again?
I think we've definitely done some chart damage. And there's no doubt about that. NOPA crush, they were looking for a 170. We got a 177 at the very high end of the estimate. So that definitely rebounded us back up, which is good. But the fact of the matter is we've done all sorts of chart damage to this market. We've had a heck of a little over $1 rally. We've given, we've broken below the 62% Fibonacci retracement. That's technically a very weak sign. Traditionally that opens the door to test the lows again. There was two things that drove the market up, Jesse. It was the end of the month. It was the end of the quarter, and the Fed changed the game. And what I mean by that is the funds were short a lot of ag commodities, not just the beans, but all the ag commodities in general, as a way of essentially hedging against the Fed. Remember, when the Fed's raising rates, they're trying to slow down the economy. When the economy is slowing down, you don't want to own commodities. So as the Fed got aggressive, saying they were going to make that transition from essentially raising rates or pausing rates to actually cutting rates, that was a signal for the funds to start getting out of their position, and they did. And that led to that heck of a rally. On top of it, you also had dryness concerns in the U.S. in August, worried about how that was going to hurt our crop, as well as a lot of hype by some traders out there about the dryness and the heat issues in August into September even, affecting the Brazilian crop. Now, we kept saying, hey, folks, it's too early. It doesn't really matter how hot and dry it is in September. It matters what's going on in October. That's when they transition in Brazil from the dry season to the rainy season, Jesse. And that's exactly what's going on here in the middle of the month. The weather models continue to bring rain forward across the bulk of the southern hemisphere, South America. So that essentially, we had that weather play built in. We're taking some of that weather premium out. The fund short covering seems to run its course. The Fed cut its rate a 0.5 point, but they're not getting so aggressive that it seems like the funds want to be long on the inflation play. They've moved to the sidelines. So now what's developing is we don't have a natural buyer in the market, but we do have a natural seller. That is the commercial, because as the elevators are filling up, and more importantly, as the farmers are filling up with their bean harvest, they're getting forced to bring the beans to the market. And when they bring the beans to the market, it obviously gets hedged up by the elevator, and that's putting the downward pressure on the market.
So I think about all of those factors combining together here. I have to think that support down around those summer lows in beans. I mean, I have to be well within conversation here, I would say. You look at the close on Tuesday, I mean, 991 on November beans at the close, but going down to that 950 level or further yet, I mean, I'd be concerned about that, Jim. What do you think?
I think if you're a producer and you own beans, you got to really be concerned. I mean, cherry picking analog years is always a dangerous game. Jesse, a lot of traders do it. We do it ourselves. I do it myself. I mean, 2014 was the analog year we all followed until it kicked us in the teeth here the last couple of weeks. But what I want to point out is what happened last year. Last year, the bean market had a nice little run at the very tail end of the season, roughly from mid-October to mid-November, I believe it was. And then proceeding from mid-November all the way into mid-January, the January contract eventually erased the dollar-plus move they had last year, went down almost $2 and took out the quote-unquote what people thought was a fall low by 50, 60 cents. Could that deja vu happen again this year? I believe it could, kind of under the same time frame, because as we get into the latter part of the 2024 year into 2025 year, and the trade gets confidence that that Brazilian crop is there, we've got a huge problem. What I mean by huge problem, Jesse, I mean the projected world stocks will be the highest ever. Now, we always tell people, don't look at gross stocks. You need to look at stocks to use, because we are consuming more and more product every year, and hence the very good crush number we had. The problem is the world stocks to use will be the second highest ever. So no matter how you slice it, we are going to have an abundant supply of beans in the world. And my fear is that's not $10 beans. That's probably low $9 beans. And the reality is you can economically probably justify an eating from some of these beans into the gut slot of their harvest. So I think that is the risk. So, right now, if you're going to press me which way we're going, I think the odds are high, unfortunately, that we're at least going to try to put a double bottom in. And like I said, if the trade gets confidence, as the key word, that the Brazilian crop is going to be a monster crop, I think we go lower, because the one I'm going to make is, you look at the U.S. balance sheet, projected carryouts, what, Jesse, 550 million. But to get there, they raised exports 150 million. You mentioned it. Sales to China have not been great. So are they going to pick up? Maybe, maybe not. Their window to buy beans is right now. In another 6 weeks, that window starts to shut very, very fast. So if they do not pick up their pace and the Brazilian crop gets bigger, the government's going to have to come to the conclusion, I believe, that, hey, that U.S. carryout's not 550 million. It's 600. It's 650 million. Same story. That's not $10 beans. That's possibly not low nines and maybe $8 beans.
Well, great point there with China. We were touching on that before the segment, and really, export inspections numbers came out Tuesday. They weren't great for beans, and you think about all the talk of Chinese stimulus and their economic concerns, et cetera, and we always, we know there's more export partners out there than China, but we always seem to default to talking about China. And it just feels like there's a lot of concern on multiple fronts here in terms of U.S. ag exports to China moving through the fourth quarter and into 2025, Jim.
Well, I think, and then it definitely is a concern, Jesse. I mean, China has not been an aggressive buyer of U.S. beans here. They have been buying, but, I would say it's relatively low amounts. Like I said, the window is now. There's a massive debate within the industry as to why China's not buying. Is it political? Is it the fact they just don't need them because the economy's slow? We don't know. I would guess it's a combination of both. I believe that the Chinese are very leery, looking like they're putting their weight or their thumb on the scale of the presidential election here in 3 weeks. The last thing they want to do, I think they fear like being accused of trying to influence our election one way or another. But I think that's kind of delayed some of the problems we're going to see. And what I mean, Jesse, remember, President Biden put some tariffs on Chinese electric vehicles. China expressed their displeasure verbally, but they really didn't push back as far as we know. But then what followed up was Canada did the same type of tariffs, and China pushed back, started investigating canola dumping, and did some other tariffs on Chinese goods. Then just last week, I believe it was, the European Union slapped some tariffs on the Chinese EVs. They pushed back, did some tariffs on some European cars and other tariffs. So what I believe is we did not get the tariffs pushed back yet. My guess, unfortunately, is once we get through the presidential election here in 3-4 weeks, even no matter who gets elected, there's probably a good odds are we're going to see some tariffs, kind of a pushback. And that may be why we're just not seeing that aggressive buying from the Chinese. Now, we have seen rumors of China in to buy beans recently, but we're hearing some of those beans they're purchasing, Jesse, are Brazilian beans and not our beans. So, like I said, it is a concern because, like I stated, if China is not buying, and right now our balance sheet's assuming we're going to sell 150 million more bushels of beans this year than last year, we've got a problem. Those demand does not show up on our balance sheet. It's going to get really top heavy, which means the market's going to have to go lower, either to dissuade producers not to plant beans in the U.S. this upcoming spring, or at least compete with a Brazilian price, which could be a lot lower if their crop is big.
A new economic study out Tuesday from the American Soybean Association and National Corn Growers highlighting what a trade war could do and how it could hurt U.S. farmers. So a lot of concern there. In terms of the corn market, Jim, corn feeling a little range bound-ish still. I think just continued harvest pressure there, but I'm a little more friendly this corn market. Are you?
A little bit more. I mean, the beans did a lot of technical damage. They took out trend lines and a Fibonacci. The corn right now is holding that 62% Fibonacci retracement of this this fall bounce. So it's trying to catch psychologically around the $4 level. I would not be surprised if we do go down and test the fall low, which is roughly 15 cents lower than it is, especially if the beans go down and test it. I think it'll pull it. The corn balance sheet, I think, is a little bit better positioned. It is a shade below 2 billion. So we are not growing it near as much as we thought a few months ago. But the reality is, Jesse, a 2 billion carryout represents about a stocks use of 13.4%. 13.4% would still argue economically corn could fall down to the 350 level on a historical basis. So I think there is some downward risk. But if there is a positive point to the corn balance sheet, it is the world side of the equation. The world balance sheet has been stocks use is hanging where it's been, slightly a little bit lower than it was a year ago. So unlike the beans where we're blowing out the balance sheet, the corn balance sheet is tightening up. The wheat market right now, we're dealing with dryness issues in the U.S. We're dealing with dryness issues in the plains, in Ukraine, Russia. There's a lot of weather issues going on. The Ukraine right now, it doesn't get the headlines, but Russia is constantly attacking the Ukrainian infrastructure. They've hit their ports multiple times the last couple of weeks. They've hit multiple civilian ships the last couple of weeks. So you never know. If the Russia manages to shut down that Ukrainian export corridor, it will change that world balance sheet quite drastically, and that would force some demand to the corn, back to the corn market, or U.S. corn market, I should say. So yes, I would agree with you. The corn market has a little bit more positive story, but just near term, I'm really not. I think we're still going to see a little bit more pressure potentially. Just plain and simple, where are we going to put this corn? A lot of elevators are full with beans, and I've had some clients complain that normally where elevators place corn on the ground, they've got bean piles. So that could be a logistics headache, at least temporarily.
Jim McCormick with agmarket.net's our guest analyst here today on Market Talk. And thinking about moving this big U.S. crop too here, Jim, and just the general seasonal harvest kind of price pressure that we can get in the markets. Another term that I love to see when it's thrown around is folks talking on social media, oh, when's the crop insurance rally going to hit? I think about seasonality in these markets, and typically, post-harvest, we can get a rally, but I wonder, just with the bearish environment that we're in, if we'll see a traditional type of post-harvest rally for U.S. futures here, Jim.
I do believe you will get a rally, Jesse, but I don't think we're going to get it for that insurance rally like people think. I mean, normally people like to think about how we bottom in late September and we rally into October to get the insurance rally to play. It's just, what we saw is we saw a rally into October. And now we've been bleeding it lower for both the beans and the corn. And so what's going to happen is we're going to start that insurance at a higher price and just slowly erode it as we go through the month. Now, I do think eventually we will get a dead cat bounce. Because once the producers put this grain away, I think they're going to be relatively tight-fisted, at least into the early part of the year. And that'll force, if not the board up, it will force the basis up a little bit. But I think you got to be realistic of how high is. Because, like I said, a 2 billion carryout, Jesse, still is a cumbersome crop. Now South America stumbles. The safrinha crop gets planted late spring, and then all of a sudden the safrinha crop is shorter for some reason. It will change the balance sheet, and you could get a late summer or a late spring, early summer rally. So maintaining ownership is probably not a worse thing you can do. But, to look for this market to rally sharply over the next couple of weeks as we finish out that insurance period, I just don't think it's going to happen, unfortunately, because we've got a wide open window and, a lot of grain coming to market. And the reality is unfortunately, the producer by historical measures was quite undersold. He just never did a good job getting the grain sold over the marketing year. So now there's a lot of bushels that you're going to have to make that decision. Do I put it in commercial storage or do I market it? Lots of times when you do the math, the commercial storage may not make it cost-wise to do it, which may just force the producer, maybe cheaper, to force the grain into the system and then maybe use an option play to re-own it. But that forcing the grain in the system will cap rallies and potentially push us down one more time. And just like the beans, maybe put a little bit of a double bottom in the corn market. And I might make note that, Jesse, a year ago, corn market rallied into the third week of October. And then from the third week of October into option expiration, first notice day, the market sold off, took away that fall rally, and took out the fall rally by 20 cents. If you did the same thing and took out the quote unquote fall low this year, which was right around 385 by 20 cents, that takes you down to 365. Interesting enough, that's right about where the September corn market bottomed. So, would it be unprecedented for it to go 365 and as a worst case scenario? No, in my opinion. I think that would be the worst case scenario.
I'm going to bundle wheat and crude oil together here, just with, I think, the globalness picture of both. And I think we know some of the main concerns in those markets. I think with wheat, it comes down to dryness in the U.S., in the Black Sea, et cetera. And then with crude oil, it seems like all eyes are just on the Middle East and the ebb and flow of that situation there between Israel and Iran's proxies having an impact on the crude market. And I think both those together, it just feels like it's global factors that haven't really changed that are moving those markets, Jim.
No doubt about it. It's not a micro effect; it's a macro effect. The global market. If you look what crude oil did, it really rallied sharply on two things earlier this month. It was what was driving it. The question was, will Israel go after the Iranian oil wells? In essence, the other thing that was driving it was all this economic stimulus out of China. But now coming in the middle part of the month, a lot of people are downplaying the Chinese stimulus, that it's not enough, it's the wrong kind of stimulus. And the OPEC saying the demand for crude year on year is going to drop. So you've got that going on. Then on top of it, here in the last 24 hours, it does look like the Iranians are going to, I don't know which way you call it, a luck or not, but Israel's signaling they're not going to go after the Iranian oil wells. They're going to go after military infrastructure. Maybe that's a way to keep the Middle East from completely going up in flames. Maybe it's a little bit of political pressure, trying to keep crude oil from going to $100 a barrel, which probably would have happened if it would have got attacked. But the last thing affecting the crude oil, Jesse, is a couple of weeks ago, it kind of got lost in the mix because of what the Iranian attack on Israel is. The Saudis kind of threw in the towel. They've been trying to hold oil off the market as a way to try to force the prices higher. And the fact of the matter is, as they were doing that, the U.S. continued to increase production. Now, a lot of people don't realize it, but the fact of the matter is we are producing more crude than our lifetime. We're producing more energy in our lifetime. We're exporting more products than we ever have. So as the Saudis are trying to hold grain, or essentially crude oil off the market, we were producing more and more. Well, guess what happened? The Saudis finally threw on the towel and said, you can't beat them, join them. So now it sounds like they may actually increase production, which is not really good for the inflationary aspect of commodities. In the inflationary aspect, you want crude oil to go up and pull the rest of the commodities up. But as the consumer front, you're going to love the cheap gas prices. If the Saudis ramp up production, the Chinese economy suffers a little bit. Cheap gas, which is good in the overall macro economy, because that is going to give the consumer more money to spend. And that leads me over to the protein side. That is good for the beef market, because if the consumer's got spending less money filling up his vehicle, he has more money to go out to eat, and that's a good sign.
Very, very true, especially that livestock market and some of that demand there as we get into the holiday season, fourth quarter. And I was going to say too, cattle hogs Tuesday really felt like a lot of that was technical trade. I know we saw some heavier pressure in cattle, but everything I saw, it just felt very technical in nature on Tuesday, Jim.
I had agree with that. I didn't see really headlines about it. A little bit technical. I mean, we've had one heck of a rally in the proteins. I'd say the rally's maybe a little bit long in the tooth. Like I said, you got a presidential election 3 weeks from now. You've got a lot of uncertainty. And I think there were some people said, you know what? We've seemed to have stalled out, especially in the cattle. We've stalled out here the last couple of days. Maybe it's time to take a little bit of money off the table, reduce a little bit of risk. And if I'm a producer out there, I would definitely think twice. I would not think twice about buying some puts to maybe mitigate some risk, because we know how quick in the livestock market this psychology can change with one or two headlines.
Jim, good stuff as always. As we close it out, anything you want to add or reiterate to folks today?
Right now, I mean, please have a safe harvest out there. I mean, with this dryness concerns we're seeing across the Midwest, we unfortunately are hearing fires happen and some, equipment catching on fire. So please be safe out there. Marketing wise, it's going to be tough. I mean, a lot of guys, there's a lot of tough decisions to be made. What do I do with this grain I cannot store on farm? The only thing I'm going to tell you guys is make sure you do your math. It may be more pragmatic. It may be more economical to actually sell the grain at the quote unquote fall low and maybe re-own it with paper, because that may actually reduce your risk. Because the one thing, remember, folks, if we are in a bear market, and it does feel like we could be building a bear market, what happens is the route, that carry that you see that's enticing you to put the grain in the bin, that's enticing you to put the grain into commercial storage, that carry will slowly erode. And by the time you get to that marketing period, say May, June, July, the prices may be a lot lower. So, do the math. If you've got any questions, just go to agmarket.net, sign up for our research, give us a call, and we'll be happy to help you out.
Jim McCormick with agmarket.net. Always good to talk with you, sir. Thanks for joining us here on Market Talk today. We appreciate it.
Thanks for having me.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.